Hi, everyone. Happy Friday. Good evening. So we are off to a late start. My apologies for running late. It's been a wild week and a very busy day with some closings, and here I am. We I just want to give you a little introduction about myself again. So welcome to week episode 11. This is a series of lives where we're doing every Friday. We may change the date. Sometimes I'm realizing Fridays are getting a little difficult as I try to promise to come on here and then all of a sudden it's a fire drill. And like, these fire drills are usually they're good problems because it means we're busy, right? Closing loans and helping clients and really we're helping a lot of beginners. And so my name is Adam Levine. I'm a private lender, hard money lender. I'm also a Gator, a sub two student. I have a passion in helping real estate investors. And so what I'm realizing is I'm getting a lot of feedback from the real estate community that basically investors who maybe they're new to hard money, maybe they're used to uh, using going to the conventional route to a bank, full doc, or maybe they just want to get started with hard money, or maybe you've done a few deals, but you still don't understand the basics. That's fine, right? Because look, this industry is evolving. When I started out, I was very wet behind the ears. I didn't really know anything over a decade ago, and then it's evolved and things are changing rapidly. Um, and you really don't know except you have experience. Even if you are a real estate flipper, buy and hold investor, you still may not understand. And so basically, what this episode is really getting back to the basics, getting back to just the basic fundamentals of the loan programs. I remember I had an interesting discussion at our networking event on this past Wednesday, and basically, the gentleman that I spoke with had he's a buy and hold investor. Seems like he's very sharp. Goes conventional. He has, you said he used hard cash and he goes to banks and he'll rather use his construction monies. And his question was, why hard money over a bank? And he was sharp. And certain things that and actually, I was able to explain to him. He's like, "Oh, now I understand." Right? Which was pretty cool because I was able to help educate someone. And sometimes, or a lot of times, I overlook things because maybe it's easier for me to understand because this is a language I talk every day, and I can talk it in my sleep, and I kind of forget that looking from the other side of the table that it's I can't assume that this, and that's why I want to get to the basics to help others understand um, this hard money lending. And keep in mind, hard money lending has a negative tone to it, meaning that the National Association of Private Lenders, which I'm a member of, is trying to do it away with that term because it just sounds bad, right? And they don't want to be um, confused with like payday loans and I guess being like a loan shark or something like that that just doesn't sound good. So we like to call ourselves private lenders, right? Private lending. Um, and this is a very interesting topic because when I got started over a decade ago, there wasn't any liquidity in the market. There was no, I mean, institutional capital wasn't there. I mean, um, and rates were, really um, hard money lending really took off back during um let's say the last recession 2008 where banks said no and you had to rely on private investors, could be a doctors, just group of people that had money and they'll pull their money together and they'll fund the loan. It was strictly just asset based lending, lower LTVs, higher rates. when we got started, for example, rates were like 14% and 4 points. Now, with the influx of institutional capital entering the market, it really compressed rates, added liquidity to the market, and actually offers better economics to the borrowers, driving down rates, and leverage has increased. I may get a little too much for education on that, but basically, the industry's evolving and it's still evolving. It's still in its infant stage, and it's become very institutionalized, which is good for you. Similar to Fannie Freddie Mac, that they create liquidity for lenders. It's very similar with these type of loans where the secondary markets buy these loans. There's recently been securitizations with these loans, rated securitizations, which basically means that now you have more investors that can invest in these type of loans that typically could only invest in rated securities. But that's a little too much maybe for this intro. But let's get back to the basics, right? So we have give me a second. Um my presentation is, let me see what's going on with this thing. Um well, what's going on? Or wait. This thing it's not working. Let me see what's going on with this thing. Um oh, there we go. So what is hard money, right? So again, what I was mentioning was hard money, generally asset based, but it's become institutionalized. These are it's type of so these are considered um business purpose loans, non-owner occupant, and these are not consumer loans, meaning we don't lend to people that live in properties. It's lent under an LLC. Um, and like we work with really good attorneys. And for example, we tried making a loan to an investor, and the investor wanted to make it under their personal name. The attorney he rejected. He's like, "No, we're not going to do this because now you deal with consumer laws." And then obviously the laws, they're different. So these loans are made under LLCs, not an occupant. You don't live in these houses. They're for investment purposes only. They're secured by property itself. These loans are, what's interesting is, for example, applying for a mortgage is very painful. It takes a long time, and they're going to ask for tax returns, bank statements, and there's a lot that goes into it. And so what's interesting with these loans is that these are there's no tax returns required, right? So you could close in 2 weeks or less. There's ways you could close in days and not weeks if you expedite things, right? And these loans are you know typically, let's say there's different types, right? You could have a fix and flip, right? Which they came up with that term. It's pretty new actually, where basically it's a fix and flip means that you're buying the property, you're gonna renovate the property to either sell the property or refinance. So when I talk to people and mention, okay, someone's looking to buy a property and they wanna, renovate it, and I tell them, oh, it's a fix and flip. Don't be confused, right? When we say a fix and flip, that's just the name, right? But you can either buy the property, renovate it to sell, or you buy it and refinance into a term loan, right? So let's say let me see some. So I may get a little bit ahead of myself, but um, so basically the purpose of these loans, um, there's long term, there's short term loans which are 12 months. There's even 30-year loans. I mean, that are called DSCR loans, right? I mean, that's more term. That's more for like a buy and hold investor that you have tenants in there and you're gonna buy and hold it. There's even loans for ground up construction, right? Where you're gonna buy a property where you have permits. ready to be pulled or they are pulled, and you're going to build a house, right? I want to keep it simple and keep it to like 1 to 4 family, right? To keep it very simple for this episode, because you could even go into like 5+ units and go to commercial, but let's keep it simple with 1 to 4 families, right? Um, so let me go to the key difference from traditional loans, right? So hard money loans, for example, are faster, right? You can close in 2 weeks or less. A bank, it could take months, right? And they're going to ask for tax returns and whatnot. And with these loans, it's not going to show up in your personal credit report. So there's no, so for example, if you need to close fast, you can close fast. If if you're not a you could be a W-2 worker, but the thing is like obviously you're going to be capped out with a regular bank because they're going to look at your DTI, and eventually maybe it's more advantageous to go to a bank if you could wait to close and you don't need to close in 2 weeks or less. And um, but eventually you're going to cap out. We're going to go above you're going to exceed um your ratio limit with the um, and then you're not going to be able to get any more loans, right? Um, And these loans are more flexible too, higher leverage, meaning that for let's say a fix and flip loan, you could, in theory, if you have experience, right? Like let's experience to us for a um, to buy property to renovate to either refinance or sell is like six deals, at least 6 similar deals with similar rehab budgets. You could come in as little as 10% down, give you 100% construction, up to 70% at the repair value. Um, so you get higher leverage. And there's yeah. So and another thing is so another thing. Let me see something real quick. So let's go to this, right? So to keep it very simple, so I have lots of conversations with people, and the how do I put this? A lot of times I had a conversation. I mean, I have this a lot. And so basically, if you let's say you're a beginner, right, and you want to qualify for a so hardware letters we could fund beginners ourselves. However, a beginner's going to have to put down like 25 to 30% down on the purchase, right? And you could come you can come with as little as 10% down the purchase. That's I mean that's on for the acquisition of property. Obviously, there's other closing costs like title insurance, property insurance, there's settlement costs, right? But we're just talking. Then there's other fees like the legal fee, and maybe other fees in there, like a processing fee, could be underwriting fees, and other fees that lenders throw in there. But I'm just talking about like for example, for the purchase. And typically, so there's a few things to keep in mind. So, um, to qualify for, let's say, like for example, I was talking to some investors, and um, they apply for a, and we're talking about here just fix and flip loans, right? I mean, for this episode, I'm just going to talk about the fix and flip loan. And then I'll go with the DSCR, I'll go into ground up construction, and then I'll go into some other stuff. But I want to keep this episode very, very, very simple. Just let's talk about the fix and flip loan. Okay. We're going to talk about 1 to 4 family fix and flip loans. We're going to talk about, like I said, the speed. Um, we're going to talk about like why you're going to use that because you can close in 2 weeks or less. There's no tax returns required. In my apologies, I'm exhausted. I made a commitment to come on here, and I'm just trying to make my commitment and stay consistent with this. Um, and so, and the purpose is, like I said, you're going to buy the property, right? You're going to renovate the property to either sell or refinance. It's very, very simple. That's a fix and flip loan. It's very, very simple, right? And you watch those shows, oh, flip that house, this and that, and that's why they come to people like us because the speed, um, and the less, it's just easier to obtain this loan. Credit is important too. You could qualify. I mean, generally you want a 680 credit score, but there's compensating factors such as if if you have less than 680, you just put up like an interest reserve, meaning let's say you have 1 month, you may have to put up like a few months of interest, like in escrow, as a compensating factor. If your credit is lower, right? Experience is also another compensating factor. Okay. And so typically these fix and flip loans are 12-month loans. They're interest only. Okay. And there's no prepayment penalties. Some lenders, what they'll do is they'll add in like you just got to be careful too, because I talk to people and they're like, oh, I'm getting these amazing terms. And I'm like, let me see it. Oh, it's a 6-month loan, 6 months, right? I mean, in my opinion, they're gonna bang you, because what's gonna happen is they're gonna go past those 6 months and they're gonna hit you with extension fees. Um, so you just gotta be careful of that. Ideally, we like to make loans that are 12 months. We may go 9 months. Um, on with someone that's experienced. And but that's maybe a little more complex for this, right? So let me get to this, right? So this is the tricky part, and this is where I really want to emphasize right here. Um, Basically, when I talk to people, right, when you fill out, let's say, a our quick application for a quick quote, right? It's going to ask for your experience, right? Keep in mind, if you're a wholesaler, right, that does not count as experience. What experience means, you actually took title to the property. You actually could trace that you were owner of that property. You could show it through entity documents tied to the HUD. Um, Wholesalers, you're just flipping contracts. You're not. It doesn't count. Another thing is, I talk to a lot of contractors, right? And what happens is, yes, technically, do you have experience? You have experience in construction, but on paper, like, you don't have experience, right? Having a GC license helps as a compensating factor, but in theory, right, that it doesn't count as experience. So what happens is, for example, right, like I said, beginners 25 to 30% down. Um, we could we fund 100% construction monies, right, up to 70% of the after repair value, right? So the 100%, so intermediate investors, right, I would say are probably 1 to 2 deals, right? You're gonna probably put about 75 to 80% down on the purchase. You still get 100% construction up to 70% after repair value. 3 deals plus, you're gonna be at like 85% of the purchase, right? You still get 100% construction up to 70% after repair value. Um, this is actually not accurate, so I need to fix this. Um, it's actually 6 similar rehab deals that are needed. Then you'll get 90% leverage, 100% construction up to 70% after repair value, right? And like I said, you need to show proof of ownership with purchase HUDs and exit HUDs. So this is the thing, right? You need to be very clear with your lender that you're speaking with, because what happens is, right, when you fill out that quick application, if you put down, yeah, I done like 10 deals, but meanwhile, maybe you were a private money partner in a deal, you just put up the money for the flipper, and but you're not tied to the entity docs that's tied to the HUD. Fortunately, that does not count. You're a contractor. You've done many, you renovated lots of houses for people, but you still can't provide proof of ownership with purchase and exit HUDs, right? You're a realtor. You're transactional. Um, Having a real estate license counts as a compensating factor, but it doesn't count as experience. When I say compensating factors, for example, um, let's say you're a um, you're a beginner, right? And you have to put down, let's say, um, 30. Let's say you have to put down. Let's go to like intermediate, actually, a little bit easier. So you did one or two deals, and you have to put down. Let's say you did one deal, and you have a real estate license, right? So if you're one deal, it's 75%. So you're putting down 25%. So the lender's giving you 75%. But that real estate license or GC license is a compensating factor. It actually helps the leverage. So now we're going to increase your leverage by 5%, bring you to 20% down, or the lender's giving you 80%, right? You're still getting 100% construction up to 70% of the after repair value, right? And you just have to be very clear, because what happens is what we like to do is right after you submit, like, for a quick quote, you put your experience level. I actually had a conversation today. The guy's like, yeah, I've done 4 deals, and we're giving you 85% of the purchase, meaning 50% down. We had a conversation today, and then what happened was, the truth was, he had no experience. I mean, he said he was doing work for other people, this and that, and then he's actually qualifies for 25% down. And I'm glad that we had that conversation, because we gave him a term sheet, and that prevents any surprises, because but what we like to do is, we like to, once you submit like a quick app, we'll send you an automated email to verify all the information, and then we'll send you a track record spreadsheet for you to put in your track record, right? And what we like to see is, to keep it very simple, we like to see similar rehab projects, right? When we say similar, meaning you bought a property, let's say you bought properties in that subject market area, similar properties, similar rehab budgets, right? And when we say similar, let's say you have a for example, you've done, let's say, 6 flips, and you're like, oh yeah, but 90-100, meaning 10% down. Lenders give you 90%. You still get 100% construction up to 70% down to repair value. If you're like, oh yeah, I own a bunch of rentals, I own like 2 or 3 rentals, and um $5,000 rehab budgets, because maybe there's some, like, I don't know, CapEx stuff, like maybe just touch up paint walls, whatever. And then you did another, I said 3, and then another 3 flips that were like, one was like 25,000, another one was like whatever, 25 and 25. Then you're like, oh yeah, but I want to do $100,000 budget for your next flip on your 7th deal, right? Because you claim you did 6, and now, well, what happened is, you technically don't have 6 deals experience, because 3 of them were like, they're rentals. It helps, but it doesn't really count, because there's such um a huge difference in the rehab budget, because you're I'm not gonna figure out the math now, but obviously there's a big delta between $100,000 budget and a $5,000 budget. Um, but you're not gonna get the 90 to 100. You may get if you can show you like 3 deals, maybe it would be at like, you may be at like 20% down, maybe 15% down. But we have to look at it a little bit further, and then we can make that decision. If you have a real estate license, that could help, our GC license, that will help us make that decision. Are you close to the subject property? That also helps as well, because let's face it, if you're like um investing, and if you're like investing out of state, that could be a risk as well, because like how are you gonna manage that project? Do you have boots on the ground or whatnot? Um, so that's kind of like that's where you need to be careful, just because I speak to a lot of people, and what happens is like they come to me because they say, "Oh, my lender told me I'm gonna get this," and then all of a sudden they switch the terms and they're not happy, and then is it the lender's fault? I mean, they should have verified the information versus taking their word. We like to verify the information. So yes, we can give you a term sheet, and then we try to get the facts right away, so then we can have that conversation. Like, look, um, you said your track record spreadsheet, and then it becomes there's no track record, or just like I said, like your rehab budgets don't match. They're not even your prior rehab budgets are not even close to. I mean, they're significantly less than the budget. Like I said, like you're doing like little $5,000 budgets, maybe 25, but now you want to do $150,000 budget. Well, it's a big anomaly. This doesn't it just doesn't really it doesn't really uh like like I said, we like to see like similar budgets, right? Um to qualify for that. Typically, that's what we want to try to push for at 90%. Like so. And so that's really what I wanted to touch on. Different types of loans, right? So we're gonna talk more about fix and flip loans. That's my dog. Probably wants to go outside. Long-term rentals, new construction, portfolio loans, right? Like I said, fix and flip loans are so this I had someone make this presentation. I have to update it. We can go up to 75% of the after repair value, but generally like to be at 70%. Um, that's pretty much it. Here, this is kind of like a few things too. The process, right? So that's another thing I want to mention too is the process before I go. And really, the first thing you want to do is a loan application, right? Or just get a quick quote. Very simple. We could give you one within like 24 hours. If it's an easy loan, it could take a little longer. Um, if it's something that could be a little bit more challenging. For example, um, we want to try to qualify you to give you accurate terms. So uh, you give like for example, like what could take longer? Multifamily, 5+ units, mixed use. That takes a little longer because we want to. There's more moving parts, and I'll leave it at that. Right. Loan application. You want to provide your purchase price. You want to provide the after repair value, as is value, and other details, right? Um, After repair value, it's like basically the as is value basically is just like what's the property as is. Remember, another thing too I want to point out is keep in mind lenders are always going to lower, they're always going to lend on the lower of the two, the purchase price or the as is value. So if you buy a property, right, for let's say 150,000, but the as is value is 200,000, we're gonna lend on 150,000. You're not gonna all of a sudden have that equity that you think you have, because you just bought the property way below the as is value. It's always gonna be the lower of the two, so keep that in mind. Um, the So once you submit the loan application, we'll give you a term sheet, right? Term sheet will basically give you it will spell out the economics of the loan, meaning the leverage, we'll give you the rate, give you like the points. Generally lenders will charge points on a loan. There could be no points too. Um and There's a appraisal. There's lenders that don't require appraisals. We require appraisals, but the appraisals could come back in 2 to 3 days if we expedite things. Um, you see here, AMC, that's just an appraisal management company. So um, that basically most hard buy lenders, they require the appraisers to be signed up with like a AMC. Um, and that's a whole other topic too, but I just want to go. Um, and I mean, it's very simple. But I just want to get through that, and I'm gonna leave on with this. I'll go to the next episode. I'll go a little bit more further in this stuff. Does anybody have questions? 'Cause I know I'm just rambling on, and maybe I have one viewer who's say hello. You have any questions? Because I don't want to leave out questions and get ahead of myself on here. I know it's late too. Um, but I mean, let me give you an example, right? So let me show you something on our website, right? Just to give you an idea. Um, let me show you real quick. I think it'd be a little easier if I kind of show you the website to give you an idea, right? So, for example, right? It's very simple. This is the way it's done on our website. So, right here, quick quote. You could access our quick quote actually here. Um, you can go here, get a quick quote, you get a proof of funds, you can book a call, you can even get it here, but we kind of made it simple where it's gonna pop up. I'll show you right here, boom, right? And with us, we're constantly innovating our quick quote. This is just a quick application, takes less than 5 minutes. We try to make it as painless as possible. So, like, let's say you have a deal, right? And you want us to take a look at it and look at the deal and let you know if the deal works. Feel free to use this, right? Generally 24 hours or the same day, but we tell you 24 hours. More complex deals, it could take longer, right? If there's more brain damage to be involved, right? We have referral partners that we added here. We have promo codes, offering free appraisals, and we'll offer discounts and stuff like that. We just added this here. How did you hear about us, right? Are you a broker or a gator? So let me just a little thing, a step back, right? So referral partners, if you want to be a referral partner, just let us know. We can add you here. Keep in mind, as a referral partner, you're hands off. You let us know to put your name there. Your client or your referral will put your name there. The borrower is going to get the email. You put yourself as a broker or a gator. The broker or gator gets the email. The borrower does not get an email. Difference is brokers are usually just sending us loans. They want to be the middleman, collect the documents, be in communication with their borrower. A gator's a little bit different. A gator, they can do the same thing, but the gators could also want to participate in a loan. Meaning they maybe want us to fund the first loan, and then the gator may want to come in as a gap funder or somehow be involved in the deal. You put your name, right? So I'll put my name, and this is actually good to how to get started too. It's actually, I want to show you guys this real quick. It's so simple. Put my phone number. I'll put my put my cell, whatever. Email at Levine Capital. All right. You put your target close date. Oh, I want to close whatever. Let's do May 1st, whatever. Make up a day. Loan product, right? So we're just sticking to fix and flip, right? We offer different types of loan products. Let's say fix and flip because you want to buy, renovate, either refinance or sell, right? Desire leverage, you can put whatever you want here. You can put 100% if you want. Doesn't mean you're going to get that, but in order to get 100%, keep in mind we would have to combine two loans, meaning we would offer one loan as up to 90% of the purchase price, and then we'll just bring in we could fund the second loan or bring in another investor as a second lender on the deal. Purchase under contract or not under contract doesn't really matter. Well, it does. Let me step back. So if you put that purchasing on the contract, you're not going to get an automated proof of funds. If you put it's purchased not under contract, you're going to get a proof of funds with it. So then you can go put the property under contract, right? So let's say it's currently under contract. How's the property being sourced? Actually, I may have to fix this. Let me see. Oh, no, it's fine. All right, current under contract. So you say how's it being sourced? This is important because it's for example, let's say you have a wholesaler and they ask what's the assignment fee. We just need to know what the assignment fee is because we need to have a paper trail, and then we can finance the assignment fee, right? But we just need to see all that. What is the purchase price? I'll keep it right. Let's do private sale. I'll keep it simple, right? What's the purchase price? Whatever. I'll make up a number. It could be 250,000. Boom. Right? Rehab completed. Keep in mind too. There's also yeah. I'll get that in another episode. Yes, there's a rehab. Oh, what's the rehab budget? 50,000. Right? Expansion or changing use. That That's more for experienced people. Meaning, are you going to add square footage? Are you adding a level? Changing use? Are you converting? Maybe um, like commercial to residential, whatnot. Right? Just say no for now. We're staying basics right now. Next, right? Oh, property type. Oh, single family. Right? Could be single family. Could be duplex, triplex, quadplex. Right? Quadruplex. Let's say single family, right? Oh, what's the address? I put our old house that we used to live in, or my father. I'll do 10 Berkeley Place. My father sold this house actually. It's Colts Neck, New Jersey 08873. No. Holy cow. It's been a long day. Yeah, 07722. So keep in mind if you put the purchase price and the as is value, it doesn't matter. I just say, what did we say the purchase price was? 5. When I make up the number. Wait. 250. All right, that's right. It's been a long day. I'm sorry. So this doesn't really matter. You could put, the as is value is 500,000. It doesn't really matter because we're gonna land on the lower. Just put the same as purchase price as value. Just put the same, right? After you pay, it's make up a number. 500,000. Right? That's the Airbnb. So what that means is you're buying the property, you're forcing equity, you're gonna buy the property for 250. I'm gonna put 50,000 into it. It's gonna be worth when I'm done renovating the property 500,000, right? We like to put estimated monthly insurance because we like to underwrite if it's gonna be so you want to underwrite two exit strategies if you're gonna flip it or refinance into a term loan. So we like to just as a backstop. Okay, if you can't sell, can you refinance it? This just helps with all underwriting. So I'll just make up a number. You don't know the monthly insurance, just make up a number for now. We could figure it out later. It's not a big deal. What's the taxes? I don't know. Let's make up a number. 500 a month, right? HOA, no, right? Estimated monthly rental income, make up a number 4,500, right? Is it rural? You don't know. We always just keep in mind rural properties are tough to find. We could finance rural properties, but not for beginners. Like more experience, we could do it, but there's usually leverage reductions, right? Exit strategy, refinance, sell, buy, hold. Let's just say sell, right? This is where you want to put like the project summary. You just want to put like information in there just to give us an idea. Oh, I'm a contractor. I bought this property. I'm a realtor. Whatever. Like you can just put whatever you want there, right? Give us. Oh, it's a house in Colts Neck. It's a beautiful house. I'm gonna sell it. Whatever. You could just put whatever you want there. So this is where you put your name, right? Let me do this. Name. Wait, that's weird. I think I gotta fix our application. I think there's a duplicate. I just realized. I'm gonna fix that. Oh, that's weird. Oh, email. Let me see something. It doesn't make any sense what I just saw. What? I thought we fixed this. I'm sorry, guys. Now it's kind of just. Oh, that's what happened. Ha! I forgot. Nope, it's fine. I did a duplicate. I just tried to do a duplicate. I said I'm a gator. That's why that happened. I saw so no, I apologize. So I knew something was up. It didn't make any sense. I'm like, why am I put my information in twice? So so if you're a broker or gator, going back real quick. Let me go back real quick. So what happened was, if you choose that you're a broker, it's going to ask for your information. So then you get an email, right? Or if you're a broker, you get the email and the broker gets nothing, right? The broker gets the email, the borrower doesn't get an email, right? So just put no. Very simple. Let's move on. We're almost done, actually. It's super easy. Estimated credit score. You can put 800, whatever you want, right? Cash insurance, 50,000. Experience level, right? So this goes back to like, I've done 10 plus deals, right? So keep in mind, like, that's where we want to verify things. Usually it's a 3-year look back. Also, we could go further back, but generally most lenders are a 3-year look back, meaning show me the past deals you've done in the past 3 years or 36 months. Foreign national, yes or no. We can fund foreign nationals, but generally it's at reduced leverage. This is compensating factors. But general contractor, great. Keep in mind, bankruptcies, foreclosures, mortgage rates. This is a 5-year look back. So if you have one of these in the past 5 years, you're going to get rejected by most lenders. A judgments, past felonies, past 7 years, you get rejected, right? This is if you're just adding someone else on the loan. And wait, what happened there? Oh, no, we're almost done. Oh, I didn't finish this. This is just putting it. The reason why we ask for the entity information is it's for tracking purposes in our system. But you could just, if you don't have one, you just put TBD if you want. It's an LLC, one TBD. You can do that, or you can put whatever you want. If you have it at these, but it's Levine, but whatever. You just put whatever you want. Levine houses. LLC, right? Whatever. Or TBD, whatever you want. Just for tracking purposes. That's it. Then what happens is, let me see if I can find this real quick. I can show you what happens. It's pretty cool, actually. Let's see. Now look at this. Ooh. So now I just got an automated email, right? And make sure you reply also, so the whole team sees it, right? And wait a second. You should get, here it is. Boom. So you should get an email like this. No, actually, that's not the email. This is all actually internal stuff. Wait. Well, I probably show you this. Let me see. Gotta be a little careful. I don't want to show all my emails. So basically, you're gonna get something like this, an email. Actually, you're gonna get an email basically to verify information, and then you just want to respond like, "Oh yeah, that's correct." And then you get the track record spreadsheet. You put that in there, and that's how you verify. That's basically it. Super simple. So, all right, it's Friday. I'm tired. Everybody have a great weekend. Happy Passover and everything. I'm gonna hit the gym and try to enjoy the weekend. It's been a long day, but thank you for listening to me. I know it's been this is a challenging episode for me. I'll try to be consistent. And if you have any questions, please let me know. If you have any questions, I'm here to help. I know that I probably missed some stuff here, but let me know and I will help answer next week. So everybody have a great weekend. I'll see you next week. Bye now.